Canada, the world's second-largest country, is an intriguing economy to study due to the challenges it currently faces. At first glance, Canada appears to be like any other advanced economy, with a high standard of living, advanced industries, high incomes, and a sophisticated financial system. However, beneath the surface, Canada struggles with various macroeconomic problems, which have led many economists and even the Organization for Economic Cooperation and Development, or OECD, to predict that it may perform the worst among advanced economies in the next few decades. These are substantial statements, and it is essential to recognize that nobody can foretell the future, especially economists. However, the concerns raised by these organizations are legitimate, and we can learn a lot about the obstacles that our own economies will encounter. Although Canada may be the economy hardest hit by these issues, other economies will not be immune, including its southern neighbors. So, what causes Canada to have the lowest projected growth among advanced economies for the next 50 years? Will these issues affect all economies? Is there a solution to address these problems before they significantly impact the Canadian people? Geographical location. Canada's geographical location is both a boon and a bane. Being situated near the world's largest economy, the United States, has benefited Canada in many ways, including being the United States' biggest trading partner. Additionally, Canada enjoys access to both the Atlantic and Pacific Oceans, allowing for more opportunities in international trade. Despite these advantages, Canada's position has also resulted in most of its landmass being uninhabited tundra, with the majority of its population concentrated in a few urban centers close to the southern border, where the much larger and more dominant US economy is located. Although geography is not the primary cause of Canada's problems, it could exacerbate many of its issues. How productive are Canadian workers? The real issue lies in the fact that Canadians earn less than their American counterparts. On average, Canadian salaries are lower, and Canadians, on average, do not produce as much as their American peers. One reason for this disparity is fairly simple to understand. Americans work longer hours than Canadians, giving them more time to create economic value. However, even after accounting for work time, Americans are still over 30% more productive than Canadians. On average, an American worker generates $66 worth of value per hour, while their Canadian counterpart generates only $50 worth of value per hour. The reason behind this significant productivity gap are not so easily explained. While some might argue that it's due to workers' rights or excessive breaks, the truth is more complex. Many economists have hypothesized that the gap is a result of the different industry compositions in the US and Canada. America has a larger concentration of high-income industries such as Wall Street and Silicon Valley, which raises the national productivity average. In contrast, Canada lacks a real equivalent to these industry centers. If the explanation was accurate, it would suggest that the productivity gap is not particularly meaningful. After all, a few high-value industries lifting up the national average does not provide much insight into the experience of the majority of workers in the economy. However, the OECD has found that even while examining industries individually, Canada still lags behind the US in terms of productivity. Therefore, the notion that high-performing industries are the primary reason for the productivity gap does not hold up under scrutiny. The USA's huge investment capital. The true cause of the productivity gap is that the United States invests much more in increasing worker productivity. To produce anything, the production components of land, labor, and capital are required. A country's labor force productivity can be increased by boosting its youth, education, and health. Additionally, land is more productive when it is near water reserves or numerous natural resources. Finally, as more resources are spent in capital, such as machines and infrastructure, it becomes more valuable. The United States has been able to increase productivity by increasing more in these variables than Canada. It's also crucial to note that improving any of these factors can have a positive impact on the other two. For instance, if a country discovers a better way to manage its farmland, it can support a larger population of younger, more productive workers. With a larger population, there will be more individuals capable of innovating and improving capital. Similarly, capital is essential in enhancing the productivity of both land and labor. Ultimately, investing in any of these factors can lead to a virtuous cycle of productivity and economic growth. For example, a single accountant using Microsoft Excel on a computer has the ability to perform the tasks of 2 accountants using calculators, or 5 accountants who rely on mental calculations. Similarly, a farm that employs modern irrigation systems, genetically improved crops, and advanced fertilizers is likely to yield significantly more produce per acre compared to a farm without such technological advancements. These tools, including computers, calculators, fertilizers, and irrigation systems, are referred to as capital by economists. Capital investments are essentially resources that enhance the efficiency of both labor and land, and this is an area where Canada is lagging behind the United States. In 2019, Canadian businesses spent nearly $13,000 per person on capital expenditures, which included everything from office furnishings to cutting-edge equipment. In comparison, American businesses spent $20,500 per employee, which is 50% more than Canadian enterprises. The availability of infrastructure finance in the United States is a substantial contributor to this disparity. The difference in financial markets. The United States is a corporate investment hotspot owing to its public markets, which appeal to both domestic and foreign investors. Although Canada has its own public stock exchange, it is not as large as the one in the United States and does not attract the same amount of international investment. Although it is purely anecdotal, many individual investors around the world allocate approximately 1/3 of their investment portfolio to US companies. This is largely due to the fact that the US is a logical choice for investment as it uses the world's reserve currency, has a favorable business environment, and is geographically expensive, making it a default choice for many. This investment trend has even impacted non-publicly traded companies within the US. Take, for example, Steve and Joseph's construction companies. Steve here owns a construction firm in the US, while Joseph's business is based in Canada. Both owners require $1 million to purchase a new warehouse for their equipment, and they begin looking for investors. However, the American company is more likely to secure funding due to the abundance of investment capital available within the US. When a company's shares are listed on a public market for the first time, it is called an initial public offering, or IPO. In many cases, the funds raised through an IPO are not utilized for the company's operations, but rather to repay early investors so they can invest in new ventures. This occurs on both the Nasdaq and New York Stock Exchange, just as it does on the Toronto Stock Exchange. The primary difference is that the American markets are much larger in proportion, providing greater liquidity to businesses of all sizes. Despite the disparity in capital investment between Canada and the US, Canadian workers are still able to achieve a remarkable level of productivity. However, the relationship between labor efficiency and capital intensity is not clear, and there comes a point where additional capital investments will result in diminishing returns. So, why does this matter? While most countries in the world have less productive workers than the US, the question remains why this is not necessarily an issue for them. A silent rivalry? Canada is facing a significant challenge with regards to productivity, particularly due to its covert competition with the United States. Canada and the US share an economic rivalry that is worth noting. Despite being allies and having open trade policies, the two nations are culturally similar but competitive in nature. The intense competition between Canada and the US amplifies the struggle for talent acquisition. Annually, approximately 45,000 Canadians relocate to the US, while only about 9,000 Americans migrate to Canada. Despite the constant social media posts that threaten otherwise, the decision to move is mostly driven by opportunities. This is because American workers earn higher salaries on average, especially those with advanced skills and qualifications. Moving to the US can be a lucrative decision for top income earners in Canada. as they can earn significantly more money and pay fewer taxes on their income. Although the Social Security benefits are not as robust in the US, it is not a major concern for high-income earners. As a result, Canada experiences a brain drain of highly skilled workers, leading to a persistent talent shortage. To address this shortage, Canada has been filling the gap with skilled migrants. Housing affordability. While skilled migration is beneficial, it has some side effects, with housing affordability being a significant concern, especially in Canada. Although Canada is a vast country, most people reside in a few metropolitan cities. The rising housing prices have been a challenge for Canadian cities for the past 2 decades, and the problem is more pronounced now. Furthermore, higher land prices can adversely affect businesses as they may have to spend more money on renting or purchasing their facilities, leaving them with fewer resources to invest in capital, employee wages, and tools required to add value to the economy. The rising housing prices not only affect the business's ability to spend, but also make it harder for them to raise capital. Investors and banks may shift their focus to the real estate market rather than the business financing market, exacerbating the issue. This housing affordability problem further worsens the situation of skilled Canadians who are considering migrating to American cities, where they can earn more and pay fewer taxes. Unfortunately, Canada's growth has been sluggish and is predicted to remain so according to the OECD. Over the past decade, Canada has not experienced any nominal GDP growth. Despite this, Canada does have a robust service, financial, mining, and agricultural industries. Although it may be overshadowed by its southern neighbor, Canada is still a significant player on the global stage. What do you think? Is Canada's economy truly stagnating? Comment your thoughts below. Thank you so much for watching. If you haven't already, click the like button and subscribe to our channel and turn on notifications to stay updated.